and thanks for tuning in for this quarter's Student of the Market Update, third quarter 2023. We're going to take a look at what's been going on year to date in the markets. We're going to talk about a couple important themes to be keeping our eyes on as we near year end, and then we'll talk about a couple strategies to put into play as a workplace retirement plan investor and some things to be thinking about with retirement income planning. My name is Sean Bjork. Our role is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings program. And with that, let's get started. Let's take a look at what the markets have done year to date so far in 2023. Welcome news with a nice bounce back for stocks through the end of the second quarter. Stocks were up almost 17% versus the prior year when they were down 18%. Bonds up about 2% after being off 13% last year. So welcome news for retirement plan investors and investors as a whole. Oftentimes when it feels like nothing is working in the portfolio, stay tuned because shortly to follow it can feel like everything is working. So along those lines, let's look at what some broad categories have done year to date. And we see that most asset classes have made money this year. 94% of asset classes are up this year. The exact mirror image of what we saw last year, where 94% of asset classes lost money, very similar to 2008. So again, oftentimes when it feels like nothing is working, stay tuned, and then it feels like everything is working, and that's what history has tended to show us. So with that, who do we have to thank for this rally? Well, we have about 7 stocks to thank if you're a U.S. large cap investor. And so specifically the tech concentration in the U.S. large cap index, we can see that there's 7 names have driven roughly 70% of the return. You know these names: Apple, Amazon, Microsoft, Google, etc. And it's important to keep in mind, when we think about this, it's a little bit different than 2000, than the tech bubble. That was the whole broad sector. Remember Ask Jeeves, right? There were crazy valuations across the entire sector. This is really just these 7 names with the, crazy valuations, pretty darn high, but not so much the sector as a whole. We haven't seen it broaden out a little bit, but just something important to keep an eye on, and we'll talk about that concentration of growth in our portfolios shortly. So with that, let's talk about volatility. This is something we've hit on in previous editions, and a story that not a lot of folks have been talking about year to date, which is just that volatility has been incredibly low. We've only had 2% or greater market moves year to date, versus 46 last year, which is quite a drop off in volatility, almost eerily quiet, and just something to keep an eye on as we continue to wrap up the year. So with that, let's talk a little bit about the yield curve, and I promise this is as nerdy as it's going to get, but we have reached what appears to be peak inversion, and then it's backed off a little bit. So what does that mean in English? It just means that short-term interest rates are higher than long-term interest rates, but they've backed off the peak a little bit. So what does that mean? Well, traditionally, if we look at the chart here and we look at bond returns following those peak inversions, historically, when we back off of that peak inversion, it does tend to be a favorable environment for bond investors. Another thing to think about on this chart and to consider is that oftentimes a recession follows on the heels of that peak inversion and then the curve backing off. So 2 things to think about as we come into the end of 2023 and as we move into the fourth quarter. It'll be interesting to see if history repeats itself in this specific instance. So with that, let's talk about the couple themes to keep an eye on. Right, we just talked a little bit more about the keeping an eye out for what bonds might do the rest of the year. We talked about that oftentimes after this peak inversion, they're historically soon to follow. Oftentimes there's a recessionary period. The other thing to think about, and we talked about it in the last edition, is this concentration of growth in the U.S. large cap stock index. Specifically, if we look at the chart here, we can see that of the names and of these growthy stocks in the U.S. large cap index, it represents about 41% of the stocks in the U.S. large cap index. Out of these top 10 names, 7 are growth names, with only 1 being a value name, and that's frankly a pretty soft value name at that. So while growth has been the story of the year, and it's been something that many investors have appreciated as a tailwind, it could also be a sneaky risk factor in a lot of U.S. Retirement plan investors' portfolios, having such a concentration of growth for those who are relying on using the U.S. large cap index as their exposure to U.S. large cap stocks. So just something to be mindful of, something to keep an eye on as we move forward in our retirement plan portfolios. So finally, all this information is great. What are two ways we can put this into practice? Well, first is the concept, and we've talked about this before, winning more by losing less. So you see two examples here. On the left, you're looking at full octane, right? 100% of the up moves, 100% of the down moves of the US stock market. On the right, you're looking at a hypothetical portfolio built to capture 3/4 of the up and 3/4 of the down. So oftentimes we find, history has shown us, if we can smooth the ride out a little bit, if we can lose less, we don't need as much on the upside to make up for that, and we can have a smoother ride and end up in a better place. And this really speaks to what we're trying to do with a diversified workplace retirement savings plan portfolio. Finally, let's talk about retirement income planning, right? And in this slide here, it's titled Dollar Cost Ravaging, but really the thing to think about here is within the context of creating a retirement paycheck for yourself. So this is an example of the worst case scenario, an investor retiring into the bursting of the tech bubble. And what you're seeing here in the green is an all stock portfolio. And you can see, if you follow the old adage of 4% drawdown and a 3% inflation adjustment every year, you come pretty darn close to exhausting your money really quick, right? So, it does not, take a financial professional to say that that's bad, right? We do not want to run out of money when we're making our retirement paycheck and doing our retirement income planning. The yellow line that you're looking at here is a 40-60 stock bond portfolio, quite a bit better, but still eating into principal. The red line you're looking at is a purpose-built retirement income portfolio, and you can see here obviously that much better place, right? We didn't eat into principal. We were able to satisfy those those retirement income distributions, making that retirement income paycheck. And what we're looking at here is not really a recommendation per se of what to do with your asset allocation, or that the 4% rule is a good rule. Frankly, it's not. It does not tend to serve investors over a lot of different market environments. Really, the big two takeaways here are: one, have a plan. Whether you're working with a financial professional, whether you're doing it yourself, come up with a strategy. There's a lot of them out there to create that retirement income paycheck that has some resilience, that historically has worked in poor market environments, retiring into challenging market environments. The other big takeaway is what to do with your underlying asset allocation and your underlying investment strategy, right? We have the accumulation strategy. Let's be purposeful and let's think about what we're going to build in our retirement income portfolio or portfolios, depending on what our strategy is for drawdown. So with that, we're going to put some important disclosures up on the screen. Short edition this quarter, and as always, the goal for this series is to support the important financial decisions you're making, both in your workplace retirement savings plan and beyond. And with that, thank you, and appreciate your time. Thanks for tuning in to become a better student of the market, and look forward to talking to you next time. Thanks. So long.